platform I'm using is ThinkorSwim. It's a free trading platform. If you have an account with TD Ameritrade, you could get this platform. It's one of the better ones in my opinion. Has a lot of free information. Like I said, you don't have to pay anything. You don't need to deposit any money. Just have an account with TD, download ThinkorSwim, and you got this. You have the expiration date. Days until expiration, that's 3 days, that's Friday, all the way until June 17th, 2022. Those are leaps, those are longer term. And these are going to be more expensive to buy because you have more time on your side. So we're going to look at the ones that are expiring Friday. The calls are on the left, puts on the right. So just like stocks, there's a bid ask. Ask is what you pay for it, bid is what you can sell it for. The difference is the bid-ask spread. With anything, you don't really want to buy market order because you tend to pay more than you should. Options, you really don't want to pay market. If you're going to buy options, always make sure to buy a limit order and close to the midpoint. Even if it's lower, even if you don't get filled right away, kind of manage it around a little bit to get filled. Every penny counts for options. All this highlighted area, because these are calls, these are in the money already. In the money is anything below where the strike is trading at right now. If Apple's trading at 258 right now pre-market, anything below 258 is considered in the money. No, you can't just buy 195, 155, say I want to exercise 100 shares at 155. No, they're on to you. You have to pay the premium, which will pretty much make you at the money. So you have in the money, it's highlighted. You have at the money, which is pretty much where the price is at right now. That's at the money. And then you have out of the money, which is farther away from where the strike is right now. And with put side, it's the opposite. Anything above 258 is considered in the money, and below it is out of the money, because you want the stock to go down, so that's the direction in which you want to buy it. The quote is priced at $4.40, but because you're buying 100 shares, you have to multiply that by 100. So in reality, for a contract, you're paying $440. But if you're just buying calls and puts, 440 is the most you can lose. Let's say you're buying calls and Apple tanks to $200 by tomorrow. These are going to be worthless. 440, if that's what you paid for it, that's as much as you can lose. You're not going to lose any more than that. Now, as you can see, the deeper in the money it is, the more expensive you have to pay for it. And the closer at the money, it gets less expensive. And then out of the money, it's cheap, pretty much worthless at that point. Reasons why it's so cheap, the reason why you can buy this for $1, the likelihood that Apple goes up 100 points to 390 by Friday is very unlikely. These are pretty much lottery tickets. This is essentially you going to the convenience store and asking for a lottery ticket. That's what you're doing. Don't get me wrong, there's been times where these were in the money, where stock moves crazy and it's in the money, but statistically speaking, it's not in your best interest to buy these. Deeper in the money, you have you could change the Greeks. You can see all the numbers if you want. The deeper in the money, the gamma and the vega is going to be 0 and the delta be 1. Like I said, every dollar move, the delta moves up this amount, which is $1. If the delta is 0.50, that means for every dollar move, the contract goes up 0.50 cents. Delta is pretty much 0 when it's so far out of the money. Just because they're cheaper doesn't mean they're better, or that means you're getting a deal or anything like that. They're going to be worthless. They're worthless now. They'll most likely be worthless by Friday. If you want to play the lottery and say, okay, maybe, buy a few. Who cares? When you're buying options, you want to make sure that other people are buying them too. You want to make sure that there's volume too. Volume is when people buy and sell. Open interest is how many open positions people have of these. There's somebody with 15 contracts at 245 right now, and there's going to be more because there's more volume. You want to make sure people are buying it, people have it, If you buy something that has no volume, when you try to sell it, if there's still no volume, you won't be able to sell it for anything. That's why right here, the ask is 12 cents. You pay $12 to get it, but the bid is zero. Nobody's gonna buy it off you. If there's no volume, there's no buyers. Doesn't matter what you paid for it. If you can't sell it, they're worthless anyway. That's why there's all these different fluctuations in numbers. You got the 44, 6 cents, because the people who do own it, they must have put a sell limit at 11 cents or 44 cents. They're hoping somebody buys that, which, likelihood they're not. Delta's dollar move, Vega's volatility move. As volatility goes up, you'll notice it in the bid-ask spread. These will get more expensive. So one thing you'll notice about high volatility markets is when people start to fear and volatility goes up, the price of options go up as well. If you check these in January, the likelihood that something 3 days away is $500 was probably not the case. The reason why they're so expensive today is because the market sold off and more people were, shorting, buying puts, more implied volatility nowadays than there was before. That's why everything is more expensive in bear markets, because the market's expecting larger swings. So this 98 cents may be in the money. Who knows? By Friday, the market expects large swings. Good thing about ThinkorSwim is it's called Analyze, add simulated trades. Let's say you pick a trade. Let's say you wanted to buy the 257.5 strike at April 9th. Analyze buy trade, a single, and then you go to risk profile, and this shows you how much money you can make if the stock moves it in a way. This is today. The purple line is today, and this red area, this red line right here, is your break even, and past that is how much is you making money. Below that, you lose money. Above that is where you need to be to make money. Say Apple went up to 260.49 today, you would be up $119. If it went up to 270, you'll be up $700. And this is the date. You could change this, and as you could see, the red, it goes further out. So the reason why it moves further out, which means you need the stock to move farther for you to make money, the more days it goes away, because that's theta, taking the value away of these contracts. Negative 0.73, that's how much money this contract loses every day when you hold it for calls. As it gets closer to expiration, that gets larger. You lose money every day for holding that. You always want to make sure you know how much money you're losing with theta every day, how much money you could make for every dollar move with delta, how much money you could make with every volatility move, and gamma is how much the delta moves. Gamma, it gets zero in the money, zero out the money, but when you're at the money, you have a higher gamma, which means the delta will move faster. If the gamma's up, the delta may move, in a faster rate. Higher gamma means the delta will move up or down in a higher rate. On ThinkorSwim, it shows implied volatility. A higher implied volatility means the more likely a stock will move up or down and have larger swings. It shows over here the 14.94 in 3 days. So if Apple right now is at 254, in 3 days they're expecting it to be on the high side of 254 is 268 or 240. That's plus or minus $14 in 3 days. That's based on volatility. Let's say tomorrow volatility goes up, higher volatility, the likelihood that this can go even farther up. Maybe it's 278 by Friday, and then maybe it's 230 by Friday. higher the volatility, the higher the swings are. You know, it can move. So that's the option chain. You have probability analysis over here. It shows you which date, the probability that it's above or at the money or below a certain price. Let's take May 8th, 34 days away. The probability of it being above 282 is 27%. The probability of it being from 257 to 282 is 18%. 231 to 257 is 21%. Below 231 is 32%. So it looks like there's more put buyers on Apple than there are call buyers, because the probability is kind of leaning downwards. You know, anything can happen. Trump could say something. Coronavirus could be cured by tomorrow. Who knows? So that's the option chain. Important to know calls, puts on different sides. You have the strike price. You have the expiration date. Deeper in the money is more expensive. Farther out of the money is cheaper. Less likely to be in the money at expiration. But you can always make money. Let's say you bought out of the money. Let's say you bought this one, and tomorrow there's a big move upwards for Apple. Even though it didn't hit 287 tomorrow, this could still be up. This could be to like 36 cents, and you made over 100%. So, you know, people trade like that as well. You just have to understand how options work.